You can't beat the algorithm until you understand it. And that's exactly what we're going to explore today, peeling the curtain on how institutional bots really read the market. Most traders think they're competing against other retail traders, but the truth is far more fascinating and a lot more intimidating. The real puppeteers are the algorithms, designed by institutions to exploit every behavioral pattern that retail traders have consistently shown for decades. To really see the market, you need to understand how these bots think, how they hunt liquidity, and how they manipulate price without emotion. Let's start with the most important idea. The market is not random. It only looks random if you don't understand the logic behind it. Institutional bots don't guess. They calculate. Every candle wick, every fake breakout, every sudden spike in volume, it all serves a purpose. These algorithms are hunting one thing, and one thing only: liquidity. Liquidity is the fuel of the market. Without it, large players cannot enter or exit positions efficiently. So the algorithm's job is simple in theory: find liquidity, trigger it, and absorb it. Here's an example. Imagine a trader who sets their stop loss just below a recent swing low. Across the market, thousands of traders do the same thing, each unaware that their stops have clustered in the same zone. The algorithm sees this. It doesn't care about individuals, but it does care about the concentration of liquidity. When price dips slightly to sweep that cluster, it triggers those stops, instantly creating the volume the algo needs to fill large institutional orders. Once the liquidity is collected, the price reverses. From a retail perspective, it feels like manipulation, bad luck, or randomness. From the algorithm's perspective, it's just efficient execution. Now, consider a consolidation range. Retail traders see it as a simple sideways market. They mark support and resistance levels and wait for a breakout. But to the algorithm, this is a playground. Buy stops above the range, sell stops below the range, a cluster of retail orders in the middle. Every single position is visible to the algorithm as a potential target for liquidity. So, when price briefly pushes above the range, it triggers buy stops, sweeps the liquidity, and then reverses hard back into the range. This isn't guesswork. It's a systematic hunt for liquidity. And that moment, that tiny wick above the resistance, is not noise. It's a clue. Volume tells another story. Most traders glance at volume and think of it as a measure of activity, nothing more. But institutional bots read volume like a language. When aggressive buying overwhelms selling, it creates a volume imbalance. A sudden spike in buying volume, followed by slowing momentum, often signals that the algorithm has absorbed liquidity and may now be preparing to reverse. Think of it like footprints in the sand. Price moves fast through a low-volume area, leaving behind a gap. Later, it returns to that area to rebalance. That's the algorithm ensuring that price efficiency is maintained. Let's make it even more tangible. Picture this. It's the London session, and the price has been ranging for hours. Retail traders see the top of the range and decide it's time to go long, thinking a breakout is imminent. The algorithm, already monitoring clusters of stop losses and unfilled orders, pushes the price slightly higher. Suddenly, it triggers those stops. Retail traders panic, selling into the move or getting trapped. The algorithm absorbs that liquidity effortlessly, and then price drops sharply, catching those same traders off guard. Later, price may return to fill that range, but by then, the algo has already executed its institutional orders. The algorithm doesn't just hunt liquidity on one time frame. It operates on multiple levels at once: daily, 4-hour, and intraday charts, always aligning its moves to the most efficient path to capture liquidity. That's why sometimes you see a perfect setup on a 15-minute chart fail completely. The higher time frame liquidity or imbalance took precedence. Understanding this alignment is crucial if you want to stop being a victim of the algorithm. Let's talk about stop-loss hunts more specifically. Retail traders often feel like the market knows their trades. It's not personal, it's statistical. Algorithms study years of behavioral data. They know that most traders move stops too tight, chase breakouts impulsively, or double down into losing positions. That predictability is the fuel for the algorithm. It doesn't need to spy on you individually. Your behavior, combined with thousands of others, becomes a concentrated zone of liquidity. And just like that, a small dip below a swing low can trigger a cascade of stops, allowing the algorithm to collect the liquidity it needs before reversing. And here's a subtle detail most traders miss. Time matters. The algorithm doesn't operate randomly throughout the day. It's most active during liquidity-heavy sessions, the London Open, the New York Open, or the overlap between them. These are the moments when institutional activity peaks, when liquidity influx is largest, and when stop hunts and sweeps happen most predictably. Ever noticed sudden spikes at the start of a session? That's not coincidence. That's the algorithm aligning with both liquidity and volatility. Now let's bring this into a story that illustrates everything we've discussed. Imagine a trader named Alex. Alex has been watching a currency pair range between two levels for the past day. He sets his buy order above resistance, confident a breakout will happen. Across the market, thousands of traders do the same. The algorithm sees it, calculates where the liquidity cluster sits, and executes a sweep just enough to trigger all those buy orders. Alex's position gets filled, but within minutes, the price reverses sharply. Alex panics and exits at a loss. Meanwhile, the algorithm has already absorbed all that liquidity, moved the price efficiently, and left the retail traders guessing what just happened. This is not luck. This is systematic hunting, calculation, and efficiency. Another example, imagine a sudden thin candle wick piercing a low on a stock chart, followed by a rapid rally. Retail traders panic, thinking the market is collapsing. What really happened is a sweep of sell stops, liquidity collected, and then price reversed. Later, the same level may act as a support because the algorithm used it to rebalance. Once you see these patterns repeatedly, you start noticing that price is less about randomness and more about structured liquidity manipulation. Understanding these patterns changes the way you approach trading entirely. Instead of reacting emotionally to price moves, you start reading the story behind the moves. You learn to identify liquidity zones, volume imbalances, and stop clusters. You understand that breakouts aren't always opportunities. Sometimes they're traps. Reversals aren't coincidences. They're the result of absorbed liquidity and rebalancing. You stop trying to fight the algorithm and start aligning with it. The irony is that professional traders don't need mystical systems to succeed. Concepts like fair value gaps, order blocks, and liquidity zones are simply ways of understanding what the algorithm is already doing. When you align your trades with these footprints, you're not predicting the market. You're responding to the natural logic of institutional behavior. You're following the algorithm, not fighting it. So, if you want to stop feeling like the market is out to get you, you have to think differently. You need to stop guessing and start reading. Where is liquidity resting? Where is imbalance forming? Where is the algorithm likely to move next? Once you see these structures, trading stops being a gamble. It becomes decoding. The algorithm isn't hiding. It's showing its hand every day, in every wick, in every spike in volume, in every sudden sweep. You just have to learn to read the signs, to understand its rhythm, and to align your trades with its logic. And when you do that, you stop being prey and start becoming a participant in the system on your terms. If this video helped you see the market in a new light, make sure you subscribe to the channel because we're just scratching the surface. Dive into the other videos we've linked below, where we break down smart money behavior, trading psychology, and exactly how institutional algorithms move markets. Don't just trade blindly. Learn to read the footprints the algorithm leaves behind and start trading with a new perspective.